the whisper miss was all the trading desks cared about. On June 5, 2026, the global financial system watched in absolute horror as a single tech giant erased a staggering $1.3 trillion of market value in just 24 hours. It wasn't because of a major product failure, a malicious cyber attack, or a hidden corporate fraud. Instead, the most severe semiconductor collapse in stock market history was ignited by a company that actually reported jaw-dropping, triple-digit revenue growth. Here is how a tiny guide misbroke the AI boom. Before the sudden crash, chipmakers were the undisputed kings of Wall Street, priced for flawless perfection by yield-hungry investors. Traders blindly bought every single dip, assuming the artificial intelligence gold rush would expand forever. At the center of this euphoria was Broadcom, a low-profile networking titan that designs the custom silicon powering the planet's largest cloud data centers. The company's stock had soared to an all-time high of $479, with shareholders convinced that its momentum could never be slowed, making it seem virtually bulletproof to any macroeconomic storms on the horizon. The illusion shattered when Broadcom's billionaire chief executive officer, Hock Tan, stepped up to deliver the company's highly anticipated earnings report. On paper, the results looked incredible, with AI-related revenue surging 143% to over $10 billion. But then Tan delivered the forward guidance, projecting third-quarter AI chip sales of $16 billion. While that represented a doubling of sales, it fell a painful $1.2 billion short of the lofty whisper numbers that Wall Street analysts had penciled in. Even though the company technically beat on overall revenue, the whisper miss was all the trading desks cared about. But this wasn't just a simple math miss. It was the spark that exposed a systemic vulnerability. What Hock Tan admitted next on the call would soon threaten the entire semiconductor supply chain. The reaction was immediate and violent, as Broadcom's own stock cratered 12%. The panic quickly metastasized across the entire sector, causing the Philadelphia Semiconductor Index to plunge 10% in its worst single-session rout since the pandemic began. Nvidia shed 6%, briefly losing its hard-won $5 trillion valuation crown, while Micron plummeted 11%. In a matter of hours, over $1 trillion of paper wealth simply vanished as terrified traders rushed for the exits. Investors quickly realized that Broadcom's margins were slipping to 74% because building custom chips for tech giants is far less profitable than selling proprietary hardware. Even worse, Hock Tan conceded that their biggest custom chip client, Google, was actively looking to diversify its hardware supply chain, introducing rivals like MediaTek to help build their next-generation AI processors. The era of blind optimism had ended. In a market priced for flawless execution, a single-day loss of $1.3 trillion proved that even explosive triple-digit growth can trigger a devastating collapse if it falls just a fraction short of perfection. For Wall Street, the margin of error has permanently shrunk to zero, and the golden era of the chip trade is facing its ultimate trial.